Hi, this is the Cordant Market Update for Friday, July 10th, which is when you should be receiving it. I'm recording this on July 9th after the markets have closed. Just a couple reminders. We'd love any feedback that you might have, anything that you appreciate about these, anything you'd like to see drop from these, or any other feedback, especially what topics you'd like us to address here. We'd love to have that feedback. Simply reply to the email where you receive this, and that'd be very helpful. Today, we're going to address a couple things. We're going to just quickly check in on where the markets are year to date. We're going to check in on the health and economic data that the markets are paying attention to. And then our topic is going to be markets and the election. We've got an election coming up at the end of the year, as if we haven't had enough to deal with so far in 2020. There is an election at the end of the year. So wanted to address that just from a financial perspective, how we look at that and how the markets have reacted historically to an election year. First of all, just really quick, where we are year to date. So this is as of today's close, Thursday. Markets are down for the year, down slightly, and down about 7% from the peak, which was in late February. One thing that you might notice by looking at this chart is from roughly first week of June till now, the markets have been more or less flat or sideways. And I would say that's probably a good thing. We've rallied 41% from the bottom, which is normal. Markets tend to rally after a drop like we saw, which was about 34%, a very average bear market. But time to for the market to digest the economic data, the health data, the earnings data that we're getting from companies, things like that. This isn't necessarily a bad thing that the markets have gone sideways for the last month, roughly. So that's where we are year to date. Again, down slightly, at least on the S&P 500. Obviously, if you're looking at international stocks or small stocks or technology stocks, it can vary from that. But in aggregate, the S&P 500 is down slightly on the year. Some of the things that are still driving, obviously, where the market is health data that's coming out and the economic data. So taking a quick look there. Couple things that I look at and just share here is how many cases are we reporting, at least here in the U.S. So here we're looking at the United States cases per million people, and this is on a rolling 3-day average. It's compared to our neighbors to the north, just for kind of a comparison purposes. So what you can see is, obviously this is in the news, it's in the headlines, probably not news to anybody, but cases in the U.S. Have gone up in the last 3 or 4 weeks. The thing that's interesting is deaths per million. If you look at the same data, deaths per million on 3-day average, they have not gone up. We haven't seen the same spike. So this is one of the things that everybody's trying to figure out. Why is that? Is it there's simply we're detecting cases earlier and there's a lag in the data that would show up here, or is it something else? Or younger people getting it, more healthy people getting it, and obviously not having an outcome that would show up here. So that's kind of remains to be seen. We'll continue to watch these numbers, but obviously this is one of the things that the market is paying attention to. On the economy side, obviously the health data affects it, but where are the economic numbers? Just a quick reminder, we've looked at this chart before, but what the market tends to look at is what's the expectation for growth next year, not necessarily what's going on this year. So this explains partially why we can get some really bad numbers, unemployment numbers, for example, and the markets can still go up on that. So one thing is the market's looking out next year, what the expectation is for the economy. The other thing are the economic data better or worse than expectations? And so that's the other thing to look at here. Here we're looking at just some selected economic data, some of the key economic data points over the last week and this week. And what you can see is basically a lot of that economic data continues to come in better than expectations or better than consensus. So a lot of this is payroll information. So non-farm payrolls were better than consensus. Consumer confidence was better. Unemployment rate lower, which is better than the consensus. Only one that was slightly worse than consensus was initial jobless claims, which 1.43 million was slightly worse. And then some manufacturing or ISM non-manufacturing index better than expectation. So the economic data continues to come in better than consensus. put that all together, and this is an economic surprise index, which is essentially the same thing. Looking at all these different economic data points, how much better or worse than consensus is it? And as you can see, numbers still continue to come in. This is through July 7th. Of better than expectations by quite a bit, obviously. Now this swings back and forth as the bar gets higher. It becomes harder to beat the consensus, and so we'll continue to look at this over time. Where is the economic data relative to what's expected? And if the economic data comes in better than expectations, that's a good thing for the market. So that's the check-in on where we are in the market, some of the information we're paying attention to. Topic I wanted to dive into here a little bit is just the markets and their reaction to an election that's coming up. This is starting to be more part of the news cycle, and we're going to have to deal with this at the end of the year. So a couple points here. I'm sure if you've been a client for a while, you've heard us talk about this before. We've done some things on this before, but the key points here are don't mix politics and investing. And this is really hard. We're going to look at a slide here in a second that kind of everybody does this, but it doesn't make necessarily, oftentimes, most of the time, for good investing. So a couple points here. One, it's difficult to identify any systematic return patterns in election years. Then the second point is, on average, markets have been positive both in election years and in the subsequent years. So there's no kind of pattern that you can figure out and identify here of like, hey, we want to be out of the market during an election year and then we want to get in after, something like that. And then the other key point here is, under both parties, Democrat or Republican, whoever's sitting in the White House, markets are typically going to provide a positive return over that tenure. And so again, we can't just be in and out based on political party. So those are the key takeaways. And I think if there is one takeaway here, it's don't mix politics and investing. When we're doing a financial plan, this is not going to, whoever gets elected at the end of this year, it's not going to swing the financial plan that we're putting together. It's not going to meaningfully change your probability of success either way. There's a lot of other factors that are going to contribute a lot more to you having a high probability of achieving what you're trying to achieve with your finances. So let's just look at a little bit of data around that. So this is interesting. So I mentioned it's not often good to mix your politics and your investing, but everybody does it. So you're in good company, I guess, if this is the instinct. So expectations for business conditions and unemployment are one of the things that this working paper by the National Bureau of Economic Research did. And they did some surveys around this. So the way this works is the blue dots or points here that you see are people that identify as Democrat, and the red are people that identify as a Republican. So what we're looking at here is this study that they did around the 2016 election. So the panel on the left is expected business conditions 5 years out. And what you can see is going into the elections, people that identify as Democrats were much more optimistic about expected business conditions over the next 5 years. In contrast to that, people that identify as Republicans, much more pessimistic. As soon as the 2016 election happened, this flips basically immediately. Same thing for unemployment. It's flipped because higher expectations for unemployment is a bad thing, but this flips after the election. And what they point out in the paper is not only do the expectations shift, people actually shifted their allocations. So if you were a Democrat, the instinct was to get much more conservative, own more bonds and more stocks after the election. And flip on the Republican side, own more stocks, maybe less cash and less bonds. So the point is, this is kind of natural wiring to change your expectations or your outlook, and then therefore change your allocation. And our argument would be, that doesn't make financial sense. It might feel like the right thing to do, but financially, it's usually not the right call. Some data to sort of support that is, this is kind of the first couple points with the election year. On average, markets are positive, and then the year after the election, markets are typically positive. So 10% after the election, 11% in election years. And you can see here, going back to different elections, back to 1920, 28, there's some years obviously that's down. 2008, we had a very bad year in the market, global financial crisis. That was a down year in an election. But on average, they're positive across the board. The other thing to look at is presidential terms, who's in the White House, Republican or Democrat. And what you can see here is, again, either party in the White House, under most presidential terms, the markets are positive. Obviously, there's going to be some outliers, and these are typically associated with very bad financial events. So the Great Depression, Herbert Hoover was elected basically days later. The collapse in 1929 happened. So not necessarily his fault, I would argue, but obviously the market was down quite a bit during his tenure. Same thing for Bush. Was in office in 2008 and had the 2008 financial crisis basically at the tail end of his presidency, which is bringing down the numbers. So main point here is either party, we got red or blue, on average, markets tend to be up. So that's the data. That's the main points here. So again, just to recap, it's very difficult to identify systematic return patterns in election years. On average, the market returns have been positive in both an election year and subsequent year, and either party in the White House, Republican, Democrat, markets typically are going to be positive. They're typically positive 7 out of 10 years, doesn't meaningfully change under either party. So conclusion, don't let your politics and investing mix. So that's it for the update for this week. Thanks for listening. And again, any feedback you have, any topics that you'd like us to address, please let us know. Thanks.